All right, I'm Michael Hartzman, and today is Tuesday, May 12th, 2026. Back in my seat after a week off, along with my partner, Dominick Tavella. How are you, Dom?
Doing well, Mike. We missed you last week, but I know celebrating Cinco de Mayo was really important to you. So
Critically
glad you're
important to me.
back. Glad you're back.
Yes, not that I can't have Mexican food any other day of the year, but thank you for giving me the week off. I appreciate it. Um, so look, all kidding aside, last week was kind of a wild week. There's still a stalemate in Iran. Oil prices have been fluctuating like crazy, but the market, and we talked about it 2 weeks ago with Phil Blancato, the market really blew right past a lot of those concerns last week. A few were back on the table this week, but let's just go through the numbers last week. Last week, the S&P 500 was up 2.36%. The Dow was only up a quarter of a percent. The NASDAQ was up a whopping 4.5%. Quarter to date, that means halfway through the month, the quarter basically. The S&P is up 13.43, the Dow 7.17, and the NASDAQ was up is up 21% through last Friday. And really the beginning of the quarter basically coincides with the beginning of the war. So can you explain to me and our listeners what on earth is going on?
Well, that's a big ask, Mike. Big ask.
Not that I'm
But
not happy. I'm
but
not unhappy, but it's just wild.
but there is a little bit of logic to the madness. Not much, right? Not much. But first of all, those numbers are from the basically the bottom. So if we look at
Mhm.
the end of the first quarter, the end of March, that's pretty much when the market, at least for so far this year, bottomed out,
Mhm.
hopefully for the year. So we're taking those numbers off the bottom. For the year, the S&P is still up though 8.5%,
Yeah,
i.e.
still
the
very
bottom and
rich.
then rallying up.
Yeah.
So the numbers are still impressive.
Mhm.
I don't care how anybody looks at them. Here's a stat for you, Mike. 88% of the companies that have reported earnings so far this quarter have beat market expectations. They've
Mhm.
actually shown better earnings than what analysts had expected. And I'll give you one more. Friday, we got an employment number. I won't say was spectacular, but in this environment was pretty good, Mike. Really good. So as much as there's this sense out there, what's going on in the Middle East, higher oil prices, what's going to happen to the economy is actually rolling along pretty good.
Okay, so now I'm going to throw you a curveball. So I'm gonna jump right into the document we have tonight from our friends at BlackRock and a guest from BlackRock. There's a slide that we have that says consumer sentiment at all-time lows, and obviously that's mostly because of the high price of gas in the last couple of weeks and the high price of airline tickets as a result of jet fuel. So there is still a disconnect between the economy moving along and consumer sentiment kind of being in the dumpster a little bit. So what do you make of that disconnect?
Yeah, so we that's a data point we like to follow because at the end of the day, if consumers don't feel good about keeping their job, don't feel good about what's going on in the economy, they're not going to spend money. And when they don't spend money, the economy rolls over. But in this case, at least up until now, the consumer is barely slowed down. We've talked about this on past calls, Mike. Maybe the average consumer spending $50 a week more on gas prices. And I won't discount that. That's a lot of money to some people. But other people, they're kind of just rolling along with the punches, hoping that it'll eventually get better. So consumer confidence is definitely down, but spending, at least for that upper echelon of the population, spending is not slowed down.
I just want to keep you on the hot seat with one more question. And I do agree. And I think a lot of that, what you just said, has to do with the stock market and the wealth effect of the stock market. And people look at their accounts with us and their 401ks and they're feeling pretty good. But we got another data point today, about inflation, which again, all could be kind of looked back on because of the high price of oil. But these not only are they data points, Dominic, but they're headlines. So
So
what's your opinion on that?
again, for people that haven't seen it yet, the top line number on inflation came in at 3.8%. That's
Just
way
hot.
higher. I don't know
Yeah.
that it was a surprise to a lot of people. Obviously, energy prices have gone through the roof. Um, but what was a little bit concerning, at least for me, was the number where they clean out food and energy. Theoretically, it's supposed to give you a more realistic, less volatile number. Mike came in at 2.8%. And what that means in English is, hey, that energy inflation is starting to flow through the economy. Higher food prices, higher cost of living, higher everything, right? At the end of the day, if an airline has to charge you more money because of fuel, that airline ticket goes higher,
Hmm.
right? So these higher energy prices will start to flow through the economy. In the short run, I think we bite the bullet. I think we get through it. If this were to persist and at much higher prices, wow, that could derail this whole economic recovery that we're in right now, for sure.
Yeah, we've talked about that quite a bit. That red line in the sand, whether it's $125 a barrel or 150 would be,
Yeah,
really
we've seen data points where every $20 higher, the amount of economic activity actually declines. So we haven't really seen that yet, but to ignore it that it's a possibility would be foolish, Mike.
and then the other, conundrum would be we're going to have a new Fed chief. It's been well documented that the president wants lower interest rates. So here we are. Everyone was talking about when the new Fed chief is confirmed and takes his seat shortly. Will he fulfill the mandate of the Fed Reserve or the mandate of his boss, the president? And the mandates might not be the same. So now you can make an argument where we have these hot inflation numbers. At one point, does this expected interest rate cut get temporarily taken off the table?
Yeah, it's a great question, Mike. So we came into the year, and I think most of the experts were talking, two cuts this year as being appropriate. I don't think there's one expert now. Maybe we'll find one in the entire country that thinks one cut is appropriate. Now, again, if we have inflation roll over latter part of this year, unemployment maybe starts to rise. You can see where the Fed makes an argument to cutting rates. I don't see one anytime soon, and not until, and this is obviously linked to what's going on in the Middle East, Mike. If that scenario kind of resolves itself, oil prices roll over and come down, inflation comes down, we can make an argument. Hey, maybe we could use a little extra oomph here in the economy, but not anytime soon, Mike. Not unless somebody has a crystal ball and it's going to tell me this thing resolves itself shortly. We don't
Yeah,
see it.
and not to have to, far be it for us to defend these experts. But they were making those predictions before this war and before the Strait of Hormuz was essentially shut down.
You're absolutely correct, Mike. We joke about having a crystal ball, but if people, and maybe this is another way to kind of flip this discussion, if people had looked at this scenario in January, would anybody have predicted an all-time high on the S&P and the Nasdaq and the Dow? Would anybody have predicted that, Mike? Would anybody have predicted that economic activity would have been moving along, that earnings would be this good, that employment would have actually been growing, not declining? It's sort of this dual conversation here. Some things don't quite click just yet, but hopefully the picture gets better as we go down the road.
Yeah, and I don't know if it gets better. It certainly will get clearer, don't you
Clearer,
think?
right? You're right, Mike.
Hopefully it gets better. I don't want to be, I don't want to be a negative Nancy, but as we know, the market hates uncertainty. So even if we get a little clarity, I think the market will also cheer that. But again, we're getting into high driving season. We're getting into the summer months, and I do think, and it's not like broken records at this point. We say it every week. They got to come up with some resolution because this administration cannot go into the summer months with the media talking daily that the price of gas is $5 a gallon.
Look, Mike, and one last thing I want to bring up because I know we're going to run short on time. We clearly now in a state again with regard to the stock market where saying it's gotten a little frothy and certain segments of the market, of the stock market, have gotten a little frothy, a little bit too much euphoria. We're back into that whole artificial intelligence trade where investors are throwing money at certain companies, at certain sectors. That always worries me a little bit too. I don't think anybody cares about oil prices when they're making those kind of investments, but in terms of future growth and future economic activity, I think it's gotten a little frothy.
Oh my God, there are certain semiconductor companies that literally are up 20, 25% or $100 in the last 2 weeks based on a good quarter. So
A
it's
good quarter,
nuts.
and then some of them, you look at their total sales, and yeah, they're doing well, and profits are doing well, but did that justify the stock price going up 100% in a month? Hard
No,
for me to believe that's justified, Mike. But
I agree.
I don't
I
know.
agree. So look, we've been doing this podcast a very, very long time now, Dom. I think we're on 4 years or something like that. And tonight's the first night we finally have a guest from BlackRock, who is a great partner of ours. And we say it all the time, but they truly, truly have some of the smartest people in the room. And we are fortunate enough to get in the room with them a couple of times a year.
Yeah, we
Um,
we definitely listen when they speak.
yeah. And that's not, we're not plugging an old EF Hutton commercial when we say that. But so tonight we have Mark Peterson from BlackRock. He's a director of investment strategy and education. And they publish monthly a great document. It's easy to read. It has tons of information. It's called Student of the Market. The May edition was actually published, I think, officially this morning. So the timing of having Mark is perfect. So we will be right back with Mark Peterson, Director of Investment Strategy and Education at BlackRock Investments. All right, I'm Michael Hartzman, back on the Lebenthal Report with my partner, Dominick Tavella, and our guest this evening, Mark Peterson, Director of Investments and Strategy and Education at BlackRock Investments. Mark, thanks for joining us tonight.
Absolutely. Thanks for having me.
You're welcome. So look, you were eavesdropping on our conversation. Um, and we'll just ask you to pick it up where we left off. Do you have any kind of opinions or do you agree with some of the things we were talking about? Anything we were a little too pessimistic or optimistic about? What were your thoughts as you were listening?
Yeah, and I think we're well aligned with what you discussed. Obviously, it's been just an avalanche of headlines, right? Think about start of the year. It's been all kinds of issues that we've had to deal with, and the markets handled it in stride for the most part, right? You mentioned higher oil prices due to the conflict in the Middle East has taken out some of the optimism of lowering those short-term interest rates, which I think has held the market back a bit. but the economy remains in good shape and producing earnings as good as we've seen in a long time. So for us, that's really been the two-part story the last couple of years, has been an economy that avoids recession and continues to crank out earnings, and a Federal Reserve that's able to lower short-term interest rates. You think back to 2023, we've had 3 years in a row in which the stock market's been up over 15%, right? 26% in 2023, 25% in 2024, just shy of 18% last year. So it's been a nice run for the market. And it's based on those two pillars, right? That we've got an economy that avoids that recession and lower interest rates expected from the Federal Reserve. This year, it's been a little bit more of a rocky ride because we've had to price out one of those scenarios, right? We're still in a good economy avoiding recession, but now, as you touched on, they've taken out any lower interest rate expectations this year from the Federal Reserve. We do think you're right, if things go well and you can find an off ramp for this conflict and you can bring oil prices down, maybe you can bring that cut back in or two in by year end, but that's pretty optimistic. As you mentioned, nobody's really pricing that in at some point or at this point. But at some point, right, we still think the bias is towards lower interest rates. There's still some room to go. So we're still hanging on to that story of no recession plus lower interest rates at some point. Tends to be historically really, really favorable for stocks. And I think that's what we've lived with here the last couple of years.
So, Mark, I kind of posed the question to Mike. If you had seen these headlines in January, would you think the S&P, the major indexes, would be up as much as they are? And what gives? What's going on?
Yeah, I think you hit it on the head. You would not expected that at all because the scenario that has played out, you would have thought it would have hit both of our pillars, right? Not just taking out Fed rate cuts, but you would also thought the economy would have been in a little bit more fragile situation as well, right? Just you get some of that, what they call demand destruction, because everybody's paying a lot more for gas and gas-related products. So that eats into what consumers can spend their dollars on. And that hits the economy at a certain point. But we just have not seen that really translate through to the rest of the economy at this point. It certainly will, we've looked at it internally. And if oil prices stay above $100, it costs us probably about 0.5% on economic growth or GDP. So certainly it does have some effect, but the earnings that companies are able to produce at this point, a lot of it is around the excitement around it. Artificial intelligence has been tremendous. So even with half of our story still holding, we've been able to produce earnings that have kept the stock market in good shape here. So I think when you look at it historically, again, no recession plus the Fed on pause, that's still a decent scenario for stocks, and that's where we find ourselves.
So with that in mind, looking at the student of the month, you very appropriately on page 4, we've referred to the old antidote, sell in May and go away, and that's been something that's been around since Dom and I have been in the business. And you very correctly point out over the last 10 years, that strategy really hasn't worked that well. And it sounds to me that it may not work that well again this year based on what we know at the moment.
Yeah, this is something I've always talked about with student of the markets, is market seasonality, just what parts of the year the market tends to do better. And we're entering the 6-month window from May 1st to October 31st, where the market returns its worst 6-month return historically, going back 100 years of history that we have good market history. Returns about 4.5%, so it's not terrible. That's why I always take pause with the sell in May, go away. I don't think you want to sell away from 4.5%, even, right? Even if it returns around that average historically. The opposite 6 months is normally the best 6-month window for stocks, which is November 1st to April 30th. We affectionately call it turkey to tax. That's how I remember it. It's November being the month of Thanksgiving, of course, and then April when we pay our taxes. I think of it turkey to tax is that best 6-month window, you average close to 7.5% in that 6 months. So historically, the trend is pretty clear. And if you go back 30, 40 years, it's pretty similar results, where you do a little bit better in those winter, early spring months versus the summer and late spring for the other 6-month window. The other 6-month window we call mommies to mummies, because that's May, the month of Mother's Day, and then October 31st being Halloween. That's how I remember that period. That's the best I could do for naming conventions. But you mentioned the last 10 years, it's been an even split, where 5 years mommies to mummies has outperformed. The other 5 years turkey to tax has outperformed. So it's one of those realities, and we see this a lot with market data, that some of the seasonal trends or some of the patterns that you find can be overwhelmed by the fundamentals that we're experiencing. And I think the fundamentals today are, again, the earnings story coming out of some of these companies has been tremendous. You mentioned exceeding all the expectations from an earnings standpoint. That can overwhelm some of those seasonal forces that we might run into from time to time.
So I know we don't advocate this, and obviously I would be shocked if you guys do. There's no such thing as trying to really time the markets to in and out and hoping that you can take advantage of these trends. I think it's kind of silly, right, at this point?
Yeah, it's one of those more interesting statistics and stories from the market that you aren't probably going to put a lot of portfolio strategy to. I've had some folks over the years said, well, maybe you just rebalance around those time periods because that's what the history backs you up. But beyond that, it's probably the practical use. It probably is fairly limited because, again, staying in the market, not interrupting that compounding, that eighth wonder of the world, as Einstein called it, letting those returns compound over time. That's what really works and builds wealth over time. Not trying to get too cute, along the edges.
So, Mark, moving along on your document, when I get to page 6, there's a pretty glum chart about consumer sentiment. And, the headline is Consumer Sentiment at All-Time Lows. And, again, we're talking about the market being relatively optimistic and the economy is clicking along. But at the same token, the consumer has been the little engine that could for this economy for a very, very, very long time. So is there a disconnect between what the consumer is feeling and what the consumer is actually spending?
Yeah, there seems to be, and you mentioned it earlier in the show that it's a couple things. Certainly, the war brings down that sentiment. Higher oil prices, gas prices, right? The higher inflation story will bring down sentiment. But I think it's surprising to everybody that you have lower sentiment than you saw during the global financial crisis, for example, or even right when COVID was setting in the first part of 2020. It's hard to believe that. And one of the dynamics underneath that is this enormous split that we all know is there between the two parties. And they actually do that sentiment survey by political party. And it's record divide between the parties, which probably surprises no one. But it is record differences. So I think that's dragging it down a little bit because you're seeing the lowest sentiment for Democrats that we've seen on either party over the years. And this survey goes back to the late 1970s. So there's some pretty good history to lean on here. So I think just that political divide is also adding kind of an extra level down to the sentiment numbers, which might be a little bit overstated. We like to say at BlackRock, try to keep your politics out of your portfolio. I think it's a great example of that, right? Regardless of which side of the aisle you're on, try not to get too extreme on either side because it's probably your politics coming into play there a little bit. And again, you don't want that to interrupt your financial plan.
Mark, Dominic and I deal with that all of the time because I never remember a point in our career before the last 10 years where Dominic and I basically know which party every one of our clients is affiliated with. And when we talk about the market, it almost has to be couched in a way where we're either not overly pessimistic or overly, being a cheerleader. Our job is just make investments based on the environment. But you're right. It's never been like the people who are not for this party are happy that the stock market is doing well, but they're waiting for the other shoe to drop any second now. And the other half, which are in favor of this market, they think it's never going to end. Like this is just, the never-ending gift. So I do agree with you. That's been the challenge Dominic and I have gotten used to over the last 10 years in discussing portfolios with our clients and setting expectations.
Yeah, no, absolutely. We get more calls than ever, right? Where they see something on TV or they read something on the internet or wherever, and it's political and they want to do something with their portfolio, right? Which is just the wrong reaction to make. The market and the economy tends to be a much longer term path, has its own story, its own narrative to it. And some of the short-term politics just can't derail it. And I know that's hard for folks to get their mind around, but one of our favorite stats, we don't have it in this month's Student of the Market, but I'll send it along as well, is we looked at past administrations and we looked at what was the best and worst performing sectors of the economy under these various administrations. And everyone on either side of the aisle is always shocked to see that the Obama years, the 8 years of Obama and Trump won, the performance of the stock market, both overall and by sector or industry, was almost identical. So even though the politics couldn't have been more different, right, both stylistically and policy-wise, the best performing parts of the stock market under Obama were technology, healthcare, consumer discretionary. And the best performing parts of the economy, of the stock market under Trump was technology, healthcare, consumer discretionary, slightly different order. And then the worst performers under both were energy and financials were two of the top three, energy and financials were two of the bottom three performers as well. Again, under Obama and Trump, even though the policies were completely different, reflecting, again, the market has its longer term path, its longer term momentum to it. The market performed almost identical under both of those administrations because the longer term story was a recovery from the global financial crisis. You had fracking revolution bringing down energy prices and helping the economy. So that was the longer term story that overwhelmed the political differences and just the stylistic difference as well. So for us, that bigger picture, longer term path of the market and the economy is so much more important than trying to get hung up on the headlines of the day or whatever news story is driving which side of the aisle.
Mark, and I don't want to keep belaboring the point, but I saw that survey you're talking about and the disparity between the doom and gloom from the Democratic side, and honestly, a little bit too euphoric on the Republican side. Both extremes. You go, how could we be living on the same planet with basically living the same economy, but yet one is so extreme doom and gloom, and the other one, let's be honest, a little extreme on the giddy side. Have you ever seen it that bad?
Yeah, it's never been this bad, at least far as, this goes back. They probably did it by political party back to the mid 80s. So it doesn't go quite back as far as the other data. But yeah, we've never seen a bigger political divide, which is why we highlighted it in Student of the Market this month. But earlier last year, after the election, they do the same thing for inflation expectations. And it was classic to your point. Inflation expectations for the next year, Democrats had it about 8% inflation, and Republicans had it less than 1%. And guess where the reality settled in, right? Almost settled right into the middle, as you highlighted earlier, right around that 3.5–4% range, right? So the truth always lies somewhere in the middle. I think that's what you've seen. And again, for us, as tough as it can be, try to keep those politics out of your portfolio. You're not doing your portfolio any favors bringing it in.
And then moving along to page 7 of Student of the Market. This is another headline that surprised me as the stock market keeps hitting new highs. But you point out that bond fund flows are outpacing stock fund flows by quite a large margin. So I guess the logic behind that is if consumer sentiment is low and half the population is feeling pretty glum, then if they're going to sell out of their equities, they're going to go into bonds. Is that what do you attribute the bond flows, outpacing the stock flows by such a wide margin? Or is there
Yeah, I
something
think
else
there's a
to
couple
that?
things. Yeah, I think there's a couple things going on there. It's never as simple as one thing. I think first off, stock market's had a great run, as we've touched on, right? I mentioned 3 years in a row above 15%. That's only the ninth time that's happened in a 100-year history. So that acknowledging it's been a pretty good run for stocks. So I think it's natural that folks have to rebalance portfolios, right? Because you'll drift with your portfolio because your stocks are going up faster than your bonds and your cash. So you'll have to rebalance just so you don't change your risk profile. So that's one aspect. I think you get that around year end too, and beginning of the year. Sometimes that happens with activity. But I think overall, you're right. I think you've got an aging demographic as well, right? Folks are getting a little bit older, the folks that have a lot of the big dollars, and they're getting more conservative. So they tend to want to de-risk as they get older, maybe take a little bit of income off their savings and retirement. So it's natural you kind of gravitate towards bonds as well. But then you mentioned sentiment, right? If you're not feeling great, you're probably not jumping both feet into the market with new dollars, at least into the stock market. So that's what we saw in the first quarter. And I can tell you, I've been doing this for 30 years. One of the best indicators for a higher stock market is if money is coming out of U.S. stock mutual funds and ETFs, which it did on the U.S. stock side in the first quarter. You had a lot more money going to bond funds. That's a tremendous positive for U.S. stocks over the next 12 months. I think in Student of the Market, we highlighted it was up over 20% the next 12 months. In some of these periods where you saw the biggest inflows into bonds versus inflows into stock funds, I think this period was around number 6 over since the early 90s that we've been tracking this data. So it's one of those classic contrarian indicators where everybody's going to bonds. It tends to pay off to go against the herd and maybe put some money to work into stocks because folks just aren't believing the rally, if you will, if you want to think of it that way.
And Mark, I don't know how many trillions, I'm going to use the word trillions in this case, dollars worth of bonds you guys manage, but this is the first time in a long time you're actually getting real yield on your bonds. Isn't that part of the process too?
Yeah, it's a great point. You've seen it play out the last handful of years. We came through a really tough stretch for bonds and fixed income, probably the worst period in everyone's lifetime, and even 100 years of investing history, where we reset interest rates from right during the pandemic. We were below 1% on a 10-year U.S. Treasury bond, and we reset it back up over 4%, and we're about 4.5% today on that 10-year U.S. Treasury bond. So that really dragged bond returns down for a multi-year period. But we're really on the other side of that today. And one of the best indicators for longer-term bond returns is wherever your starting interest rate is. So think about it. If we're paying out about 4.5% for a U.S. 10-year Treasury bond, 10 years from now, that return for bonds is going to be right around 4.5–5% over that 10-year period on an average annual basis, meaning that's what you're returning on a yearly basis. So bonds tend to be much easier to predict that way. We are in a much better place than we were just a couple short years ago. We had some pain to get there. We had to take our medicine, right, through higher interest rates to get there. But we're on the other side now. And just think about a bond portfolio that returns 5+%. You know, that's well above inflation at even today's higher inflation levels. That's a much better situation that investors are dealing with today than a couple of years ago. So yeah, I completely agree. Much better situation. I think it just takes a little bit while for everybody to see it and for it to play out.
So Mark, let's take a break right there. And Dom, I don't know if you'll a little tired this evening, but normally I count on you when you say trillions to sound like an Austin Powers villain. So Mark didn't get to experience that. So if we
no, Mike, in all fairness, I'm usually in the billions category.
There you go.
But now we have a guest where we can literally say trillions and mean it. So that's a feather in their cap. Good for you guys.
Absolutely. So Mark, let's take a break right there. And when we come back, I want to talk about the international markets and a couple of other things we haven't touched upon yet. So we'll be right back with Mark Peterson from BlackRock. He's a director of investments, of strategy, and education. All right, I'm Michael Hartzman, back on the Lebenthal Report with my partner Dominick Tavella and our guest this evening, Mark Peterson from BlackRock Investments. He's a director of strategy and education and the publisher of the Student of the Month. And we're fortunate to have him on this night because the May edition just came out, I believe, this morning. So, Mark, we haven't talked much yet about international, both developing and emerging market. Last year, both of those sectors had great years, outpaced U.S. markets. This year, it appears that they're having, another great year, and it appears that they're outpacing. Well, the emerging markets is certainly outpacing U.S. markets. And are you a little surprised by that, with all the unrest in the Middle East and how much more dependent emerging markets are on the Straits of Hormuz than we are as a nation?
Yeah, I think that was the narrative when you saw the conflict break out, was that our economy was a little more sheltered than some of the European, some of the Asian countries that rely more on the strait for energy and energy related products. So that was the thought, was that it was going to hurt some of the international, some of the emerging market countries more, at least from an economic standpoint, right? Just taking the bite out of their economy a little bit bigger than ours. But I think what you've seen with emerging markets, especially up over 20% now year to date for emerging markets, clearly leading asset classes, is some of the excitement around artificial intelligence. And you have some countries like Taiwan and South Korea that have put up tremendous numbers year to date. So a really different way to play artificial intelligence. One story that a lot of our investors at BlackRock are behind is still this emerging market story. Because valuations, even though you've had a tremendous run up in stocks, valuations still don't look terrible there, which I know sounds a little bit odd, but we still think there might be some room to run there. So for us, it is a story that we're getting behind. Some of the other developed international markets probably not quite as attractive. thinking Europe and some of the other developed countries out there. While they still might be much cheaper than the US, some of the economic prospects just aren't as good. Some of the earnings growth isn't quite as good. They did outperform last year, as you mentioned. I think some of that was based on low expectations, decent results, and a weaker US dollar. Kind of those three things kind of helped last year. This year, right, all those three are not holding in place. So less excited about some of the other domestic international markets, more excited about emerging markets going forward.
So, Mark, if I can ask you to expand on it, because normally we think of emerging markets as raw materials and metals, mining, but you're talking about some of the most advanced technology in the world sitting in Taiwan and obviously South Korea. Is there more of that going on around the world? Is that picture expanding?
I think you see other parts of you mentioned Taiwan and South Korea. I think South Korea is up over 80% year to date from a performance standpoint. And that's one of the big differences. Some emerging market indices include South Korea, some of them don't. So you see a big difference in emerging market performance, but you're absolutely right. Where emerging markets historically might have been a lot of energy related, other pieces of the economy. Today, it's a good chunk of the technology, and I don't think we could have the artificial intelligence revolution without utilizing the whole globe, right? It's not all coming from the US, it's coming from various parts of the world, including, you think about it, some of the precious metals or some of the metals used to create some of the advanced technologies don't come from the US, right? Or other developed countries, right? They're coming from some of those emerging economies. So lots of different ways to play it, but it's definitely a big piece of that artificial intelligence story.
And quite honestly, the label emerging markets frustrates me sometimes, where China is the second largest economy in the world. And, and I don't know how Taiwan and South Korea still get labeled as emerging markets when their economy and their population is so modern and so advanced. So is there a reason that these nations continue to fall into this category? Is there a motivation behind that? Because sometimes, to me, the title emerging markets just seems a little misleading.
Yeah, no, I'd agree with you because you're right. And it's a little bit arbitrary where you draw the line. I mentioned, one emerging market index has South Korea in emerging markets. The other one has it as a developed country. So it's probably in the transition phase there. But you're right. Think about some of the countries there. Lots of different cats and dogs from where they're at with their evolution. Think of India, for example, right? Certainly not nearly as modernized as South Korea, right? Yet they sit same emerging market index. But regardless, I think for us, it's just more so understanding, right, the dynamics of each and how one index might be built versus the other, and making sure you know what you own, right? You know what's under the hood of your portfolio. Make sure you get the intended exposures that you're hoping for.
Mark, if you don't mind me switching gears just a little bit, I just had to bring it up because every time I see it, I'm a little surprised. The Mag 7 year to date is a whopping up 5%, right? And I don't know how many years in a row now we've been counting on them to lead the markets, but this year they're actually underperforming. And then there are other sectors in the AI space that are just gone. We talked about it a little bit in the opening. Have just gone a little bit, I don't know, too much, too fast. I'd love your opinion on the subject. Underperformance of the Mag 7 and way overperformance of some of these other stock sectors.
Yeah, they call this dispersion in the market, right? Where you just get a big gap between the best and worst performers. And you're seeing that in the market this year. You're seeing areas like software companies really taking a hit because there's concern that the artificial intelligence might steal their business from them at some point down the line. So software, right? Some software stocks are down double digits, even though, as you mentioned, other parts of technology are up, right, 20, 30, 40%. So that's an enormous gap, not something naturally you'd see in the market. And you're seeing this in other parts, right, as well, where healthcare hasn't done much, financials haven't done much. But value stocks have done well because energy's up, because of oil prices up over 20-30%. So you're seeing an enormous dispersion. You mentioned the Magnificent Seven, and it's been an interesting evolution over the last couple of years. You think back to 2023, I think the worst performing of the Magnificent Seven was up over 40% in 2023, and all seven outperformed the stock market. Then you fast forward to 2024, 6 out of the 7 outperformed the stock market. Then last year, only 3 outperformed. And this year, it was 2 last year, 3 this year have outperformed of those 7. So you're seeing more of that dispersion within the Magnificent Seven as well, where it's not just as easy as owning all 7 and call it a day, right? And go to the races. It's much more selective, right? Think about Microsoft has been down because it's, a software company, not as bad as some, but certainly feeling some of that pain. But that dispersion, I think, is something that we've seen. It's one of those classic cases, and we see this with the market and the economy. It happens slowly, then all at once, right? Where you could start to see the Magnificent Seven start to lose its grip on the market leadership last year. And it's kind of just continued, if not been a little bit more exacerbated this year. But it's going to be, I think, what we've seen so far this year, little fits and starts, not as easy as owning the 7. They're going to be much more dispersion from a return standpoint. So selectivity will be key there.
Mark, Don and I would talk about the Max 7 a couple of years ago, and we would always look at, the breadth of the market. And we weren't really particularly happy that 7 companies were dragging along 493 other companies in the S&P. So, I look at the chart that you have on page 8, and I'm almost thinking, okay, that's good. It's good that the Max 7 is not literally dragging along 493 other companies.
Yeah, no, I'd agree. You don't want to see a handful of stocks drive all the success of the economy or the stock market, right? You'd rather see the rising tide float more of those boats. And so I think this year, I think everybody's been waiting for it. You're seeing it more in earnings, where some of those Magnificent Seven stocks coming out of the COVID restart, they just had enormous earnings difference between the rest of the stocks within the U.S. stock market. That gap has shrunk a bunch. So you've seen earnings and results for some of those other stocks beyond the Magnificent Seven catch up. And that's where performance starts to catch up, right? When some of the fundamentals start to come more in line with each other. So I think that's a big part of the story. But no question, you'd rather see more companies participate in the success of the economy and the market.
And the data supports it, right, Mark? I mean, we just mentioned the performance of the Magnificent Seven, but the market-weighted S&P is high this year, but the equal-weighted S&P is not that far behind. I mean, it is a little bit, but not as much as we've seen years past. I think that's very healthy for the markets, shows a healthiness in the economy.
Yeah, no doubt. You're seeing small company stocks are actually up more than larger company stocks at this point. You're seeing value ahead of growth. At least from a year-to-date standpoint. Some of that's reflecting energy. But yeah, you're seeing other parts of the stock market hold up its end of the bargain here, right? Which it's been several years since they contributed to performance in a meaningful way.
Mark, I want to go back to something you touched upon very, very briefly when you were talking about South Korea and Taiwan. And that was the rare earth story, the mineral story. Dom and I are looking closely at actually adding a position that you guys manage in your ETF suite. I think the rare earth story and the mineral story is not talked about enough yet. And if you have a take, I'm just wondering if you could, expand upon a little bit more why that's so important as it relates to both solar technology and AI technology.
Yeah, no, absolutely. And this is a great example where artificial intelligence is beyond just some of the technology and some of the semiconductors, right? Some of this story is downstream, and rare earth metals conduct electricity better than others, right? So some of those make a lot of sense in some of these AI build out parts. Energy, you're seeing a lot of excitement as well because artificial intelligence uses boatloads of energy. So those would be both great examples of where we've seen excitement, where you wouldn't naturally think that that's an artificial intelligence story, but those are going to be beneficiaries of it going forward. We've already seen it with precious metals, right? And certain parts of the energy segment. Some of that's priced in as well, but it's probably not a story that's going to go away anytime soon, right? Because getting those precious metals is not the easiest thing to do, right? Pulling those out of the ground in various parts of the world takes time, takes permits, other things to get it out of the ground. So it tends to be a longer term process.
And that's part of this whole economic activity that we're seeing. A number I threw out earlier in the call here, $800 billion of investments by these, I'm going to call it the Magnificent Seven, but a lot of other companies too in AI, but it has this spillover effect on the rest of the economy.
Yeah, no, absolutely. Clearly helps across the board.
So, Mark, there's one other slide which when I read it, I thought it might have been a typo. I know it wasn't, but I was surprised. I was even surprised by it. I think our clients would be skeptical. You have a chart that says stocks have performed well following all-time highs. I can't tell you how many times a client has called me and said, "Keep me on the sidelines. I'm waiting for the dip." After we hit an all-time high. But your chart clearly over a 1, 3, and 5 year period demonstrates not to be afraid of an all-time high.
Yeah, no, that was one of our favorites that we updated this month, and it did highlight that just looking at if you bought after months in which you had an all-time high, what the return was 1, 3, 5 years out, and versus buying in a month in which you didn't achieve a high, and as you mentioned, 1 year out, it's pretty similar, right? Not too big of a difference from a performance standpoint, but 3 and 5 years later, it was a little bit of a gap between buying following an all-time high versus not. And I think that's, again, counterintuitive for a lot of folks. You'd think, hey, I got to buy low, sell high, right? But when you look back historically, all-time highs are a sign of a good bull market run, right? They're a symptom of a really strong bull market, is that you're going to be achieving new highs along the way. So, I think that's a great example that getting a little bit too cute along the edges, trying to time the market, waiting for that perfect pullback to come to put that money to work is never a great strategy. And sometimes just putting that money to work, even if it's following all-time highs, still works out pretty darn well. And betting against the U.S. stock market or the U.S. economy has not worked out too well. So I think that's really what that chart's saying at the end of the day is, again, that longer term, stay in the market story. Don't try to get too cute along the way.
So it's all the arguments against market timing, but what worries you, Mark? What worries BlackRock right now, given the headlines we have going on around the world?
Yeah, I think it really goes back to where we started. If our two pillars break down, right? If we have an economy that all of a sudden looks like it's headed into a recession, all of a sudden it's really tough to produce earnings for a lot of these companies, even with excitement around artificial intelligence, right? Then you also have unemployment go up and consumer spending, a lot of things that you hit on early on, those start to break down as well. So I think, right, we've had the one pillar go on pause with the Federal Reserve lowering short-term interest rates. They're not going to do that for the foreseeable future. But if we saw the economy all of a sudden really come under pressure, that breaks the other part of the story down. I think stocks would really struggle under that scenario because a lot of good news has been built in, right, during this rally the last handful of years. So I like to keep it simple, keep focus on those two things. If we can keep the economy chugging along, and as long as we still have the Federal Reserve on hold, not raising interest rates, and maybe at some point lowering rates, that's a pretty good backdrop for portfolios, especially stocks.
And speaking of the Federal Reserve, I know one of your more prominent coworkers was a finalist for the job. And I do believe the folks at BlackRock believe that Kevin Warsh will, stick to the mandate that the Fed has and resist the temptation of what the administration wants. Would you agree with that?
Yeah, no, absolutely. That's certainly what was indicated. We certainly got some interesting perspective from our colleague Rick Reeder, who I guess came in second per the betting markets for that job, which is probably a good thing for BlackRock. But
And us.
yeah, he provided some
Yeah,
interesting
and us as
perspectives.
investors, yeah, we're not happy for him, but thrilled for us. So
Yeah, exactly. So, but yeah, I think certainly a lot of pressure to lower interest rates. I think just getting interest rates lower would help with the debt and deficit challenges in the near term, because you finance a lot of the U.S. debt on some of those shorter term interest rates that do lean on that Fed funds rate. So I think that was the hope of the administration. Certainly, with higher inflation, that makes it very tough to do that here in the foreseeable future. And I think that Warsh and the Fed will stick with that plan. I think it'll be very tough to lower interest rates when you have inflation going the wrong way, like we've seen the last couple months.
Tom, you get the last word. You get the last
yeah, and
question.
just don't mean to put you on the hot seat, Mark, but our argument has been that even if tomorrow morning in the Middle East everybody gets up, shakes hands, and sings "Kumbaya," inflation is going to take a little bit of time to work through the system and eventually roll over. We may not see some significant deflation till the end of the year. Your opinion on that?
Yeah, I would agree. And it's probably more disinflation than pure deflation. But yeah, it's going
You're
to take, I
correct.
think we lived it
You're
with
right.
COVID, right? With just the reality that it takes when you have these supply shocks, right? You can't clean it up and turn the switch back on the next day or week or even month, right? It takes a little bit of time to get everything back to a more normal state. So I think it's a great observation and one that we talk about. Really hard to pinpoint how long that takes, but it's probably a lot longer than we would hope, right?
Mark, we're just about out of time. I just want to thank you again and the team at BlackRock for making you available this evening and you making the time and you sharing your insights with of the student of the market. And just to be clear, this is client approved, and anyone who wants to see the slides and wants us to share the deck with them, just reach out to myself or Dominic, and we'd be happy to get that to you. But again, Mark, thank you very much for
Thank you,
your
Mark,
insight.
and thank you, BlackRock, for making you available.
And
Thanks,
we are
everybody.
out of time, and we will see you next week with a new edition of the Lebenthal Report. Have a good night, everybody.
Good night, all.